IMF head Kristalina Georgieva has stated that the U.S. economy is likely to narrowly avoid a recession this year, despite the Federal Reserve's aggressive interest rate hikes. She believes that the Fed can bring down inflation without causing significant harm to the economy and suggested that the central bank should continue its interest rate hikes until core inflation cools. The U.S. added 517,000 jobs in January, but Georgieva expects to see weaker labor markets towards the end of the year. She also warned that a U.S. default on its debt would be damaging to the country and the global economy, but is optimistic a solution will be found. The IMF's global projections for the year have improved, but still remain concerning. Jeremy Siegel, a professor at the Wharton School, has warned that the strong U.S. jobs report could be bad news for stocks and the economy. He believes the Fed may keep raising interest rates to control inflation, which could lead to a recession in the second half of this year. However, Siegel still expects the Dow Jones Industrial Average to rise 18% to 40,000 points by 2025. He suggests that the Fed should pause and wait to see the effects of the previous interest rate hikes, and not crack down on wage growth, as higher wages can help fill job vacancies. Siegel believes that a strong economy could weigh on the stock market, but his projection of an 18% rise in the Dow Jones by 2025 is eminently reasonable. David Rosenberg, the Rosenberg research chief, predicts a U.S. recession starting this year and unemployment could surge. He believes the S&P 500 could drop by 30% to around 2,900 points. He suggests investing in gold, bonds, and low-risk stocks as a way to weather the downturn, but avoids cryptocurrencies. He believes that rising interest rates and the squeeze on household finances could lead to a decline in consumer spending and corporate earnings. He also predicts unemployment could go from 3.4% to over 4.6%. He expects the Fed to stop hiking rates later this year, which could boost stocks and lead to an economic recovery in the second half of 2024. He is bullish on long-dated bonds and high-quality growth stocks like Microsoft, Amazon, and Alphabet. What side we are on? In 2021, economists underestimated the inflation that was taking place globally, and in 2022 they predicted a recession due to the high inflation and interest rates by the Federal. However, in 2023, the optimists who believed in transitory inflation and a soft landing by the Fed seem to have been proven right. The recent job report showed 517,000 jobs added, and the unemployment rate fell to a 50-year low of 3.4%. This has led to the belief that a recession is unlikely, with Treasury Secretary Janet Yellen and economists from Moody's Analytics and Fudbonds agreeing that the economy is far from a recession. The trend of inflation is decreasing, the labor market is stronger than it has been in over 50 years, and economic growth is still positive. The spread between corporate bonds and Treasury yields is narrowing, suggesting the U.S. economy will not enter a recession this year or next, according to DataTrek research. The spread helps measure the risk appetite of bond traders and widens during uncertain times. A year of climbing interest rates and elevated inflation has led most forecasters to expect a recession, but the narrowing spread suggests stability and resilience in debt markets. The spread is now slightly below the 2015 to 2019 average, indicating that the corporate debt market is not more worried about a sudden decline in earnings than it was during a time of stability. U.S. stocks moved lower on Tuesday ahead of a speech by Federal Reserve Chairman Jerome Powell at the Economic Club of Washington. Markets rallied last week following Powell's disinflation comment after the Fed's 25 basis point rate hike. Investors will be looking for insights into upcoming monetary policy. Minneapolis Fed President Neel Kashkari stated that the tight labor market shows that the central bank has more to do to bring inflation under control and sees the Fed funds rate going higher than the consensus.